Well, hi there. Um, Welcome to this lesson, and this one is on Japanese candlestick charting methods. And it just so happens that I've got a wonderful book, the G7 Trading System ebook, and in this book I've got a section on candlestick charting. So I'm going to go through this with you, and at the end I'll add anything that I think may have been omitted or that needs further clarification hereafter. So let's get right into it. You saw the candles on the charts in the last lesson, what a candle looks like, how it's drawn basically with the high and the low and the open and the close of the current price. You've seen that you can have a look at candles over different time periods. We're going to focus on the hourly charts, and we do so in the G7 system as well. But you can look at candles over much shorter time periods, up to seconds, down to seconds rather, should I say. And you can also look at them on longer term charts like 4 hours, days, weeks, and even months, as you saw in the last lesson. So I'm just going to go through this with you bit by bit, and I'm going to make my own comments as we go through here. And if there's anything that I want to add to what's written down here, then I'll do so. So I'm just going to actually read this as we go along, and kind of just add bits and pieces in. So this is really on how to read a candlestick chart. So I've described this very briefly to you already, what a candlestick is, what it looks like, and what it represents. So this section is a brief introduction to Japanese candlestick charting methods. If you're a new trader, and I assume that many of you are new traders because that's why you're on this course, please read through these carefully and try to spot the patterns on your live Forex charts. So you've got your chart set up already, hopefully by now. If you haven't, you can do so in the hours and the days and the weeks to come. And when we've been through this, you need to be able to look at your charts and to try and spot these patterns on the charts. If you're familiar with candlestick charting, which you probably aren't, skip this section and go straight to the G7 trading system, which is actually contained in the rest of this book, but that's not the purpose of this course. Interpretation of candlestick charts is based on patterns. Currency traders use primarily the relationship of the highs and the lows of the candlesticks over a given period of time. However, some patterns can be identified to anticipate price movements. So what we're talking about here is looking at price action or price movements which have already happened or are currently happening to try and anticipate what may happen in the minutes, hours, and days to come. However, some patterns can be identified to anticipate price movements. That's what we just said. There are two types of candles, the bullish pattern candle and the bearish pattern candle. And we've had a look at this already on the live charts that we did in the last lesson. And as I explained to you there, and as I will again now, this is really what a candle looks like. It's called a candle because it looks like the body of a candle plus a wick. In fact, if you cut off these bottom bits here, it'll look just like a candle. And the top of the wick, the highest point of the wick, represents the highest price reached in that time period. And we're talking about hourly charts at the moment. The bottom of the wick represents the lowest price reached during that time period. And then the top of the body of the candle represents the opening price. In this case, this is a bearish candle. Remember, we had a look at, well, we did red and green, but red and blue. So the opening price was there at the top and the closing price at the bottom of the candle. So one could surmise what happened during this period, this 1 hour period, or any other period that you might be looking at, is that the price opened here, it perhaps went up a little bit, came back to where it started, and then went down all the way down here and got to the low price of that period and then bounced back up again and closed In other words, when I say closed, I mean that's when the hour changed to the next hour closed at that level. So this is called a bearish candle. Got the high, the low, the open, and the close. In a bullish candle, on the other hand, the high price again is at the top and the low price is at the bottom, just the same as a bearish candle. But in this case, the opening price was lower than the closing price. And that's why this is represented in blue. So the opening price was down there. Let's again surmise what may have happened. We don't know unless we look at shorter time periods. But it doesn't matter for the purpose of trading on hourly charts anyway. But let's just say the price opened here. It moved down. It formed a low. The lowest price it reached during that hour was over there. It moved all the way up. And the highest price it reached during that hour was at the top there. And then it fell back down slightly to close at this price over here. So that's called a bullish candle or a rising candle, one in which the price closed higher than where it started, the opening price. All right, so now what we're going to do is look at various candlestick formations. Now, often we look at candlesticks in groups of two. And what we're looking for, and this is really important, what we're looking for is candlestick patterns which indicate that the price overall, the trend, in other words, that the trend may be reversing. And what we look at is the price action, which is what you see on the chart here. Plus, we look at where on the chart the price action occurred. And for that reason, we look at Bollinger Bands, moving averages, support lines and resistance lines. We look at Fibonacci lines, and we look at stochastics. And we combine those really just a handful of indicators with the price action, which is created by candles, individual candles or groups of candles or duos of candles. And we combine that in order to form an opinion about what the market might be doing, an informed opinion, one that places the probability of predicting what might happen next more firmly in our favor. Now, this one is called a piercing line or a piercing pattern. I generally refer to it as a piercing pattern. This is a bullish pattern. The first candle, that's this one on the left, is a long bear candle followed by a long bull candle. Now here comes the important part. The bull candle opens lower than the bear's low, but closes more than halfway. There's about halfway where my mouse cursor is. It closes more than halfway above the middle of the bear candle's body. So basically we've got to move down. The very next hour, the next candle moves up. It's a strong bullish pattern because the body of the candle is much larger than the wicks of the candle. Same here. Body of the candle is much larger or longer than the wicks of the candle. And this has moved down. We move to the bullish candle, the one next to it, the next one that comes along in time sequence, and that closes above or more than halfway into, or above the halfway mark, should I say, of the previous bearish candle. That's called a piercing pattern or a piercing line, and that is a good reversal signal. When I say reversal, I'm assuming that I'm going to move the mouse cursor up to this top left-hand corner, assuming that over the preceding hours, the price has moved down. We culminated in this rather strong move down, followed by the strong move up, closing more than halfway up the previous bearish candle. That would be called a bullish reversal. In other words, we've got a price movement down, all the way down here, and we get this candle which closes in this fashion, and that's called a bullish reversal pattern. And we would be looking, as with all the reversal patterns, as with all price action or candle patterns, we're looking for these things to occur at points of high probability on the charts. like, for example, when the stochastic is oversold or overbought, or whether when we've hit a Fibonacci level, or a moving average, or a Bollinger Band, or any combination of those together. The more the better, the more the merrier, as they say. So if we got a combination of a support or resistance line, a Fibonacci level, an overbought or oversold stochastic, and perhaps a bounce off a moving average, then that's what we're looking for. The more of those that occur simultaneously, the better. And when they do occur, we start to look for these reversal patterns. I hope that's clear. Right, the next one. Well, they call it a hammer. I call it a spike low. This is a really good one. And these are patterns that you can look out for with an eagle eye, because they're really quite reliable and important. Once again, as with all of these, just bear this in mind and don't forget what I'm saying now. As with all of these reversal candle patterns or price action patterns, we want to make sure that when we look at them, they're occurring at points on the chart of high probability. So this is called a hammer or a spike low. It's called a hammer, obviously, because it's got a long handle and a small candle body, or it looks like the head of a hammer. And once again, we can imagine that the price has moved down. All of these are bullish reversal patterns that we're looking at currently. The price has moved down. We've hit one of those points on the chart of high probability, and we get the spike low or hammer. And that's normally a very good reversal pattern to look for on candles. The same thing happens, and I think we'll get to it a little bit later on in the notes here. Same thing happens when we get a bearish reversal. We get a spike high. So you can imagine prices moved up, we get a spike high, and then we expect it to move down if we're at a point of high probability. But we'll get to that shortly. A morning star. You don't see too many of these, but sometimes you do. They occur particularly during quieter markets, but they're just as useful, but not as frequent. The morning star, it's a bullish pattern signifying a potential bottom. So with all of these that we're doing at the moment, these are all bullish reversals. So we're looking for a change in direction from a movement down to reverse and for the price to start rising in the hours to come. It's a bullish pattern signifying a potential bottom. The star indicates a possible reversal, and the bullish blue candle confirms this. We're talking about this bullish blue candle. The star can be a bullish or a bearish, blue or red. Doesn't matter what the star looks like, this one here. Okay, I think that's quite clear. So once again, once you start looking at your own charts and once you've got them set up, you can look for examples of all of these and you'll be able to spot them pretty easily. This is a good one, a bullish engulfing candle. Essentially, what we're looking for is a bearish candle followed by a bullish candle with small wicks and a large body. And why it's called engulfing is because the price of the bullish candle, this one right here, closes above the opening price of the previous bearish candle. So you can see we moved all the way down and then all the way up again, and the price here closed. Remember, the top of the body of the candle is the closing price in this case. We closed well above the opening price for the top of the candle in the bearish preceding candle. And that's a reversal pattern. Once again, as with all of them, and I'm going to repeat myself over and over again, these by themselves are relatively good indicators, but to make our decisions more clear and more based on good statistical probability, we're looking for these to all occur at points on the chart where we use some of the indicators, one or more of the indicators that I mentioned earlier, the stochastic moving average, Bollinger Bands, Support and resistance lines, those are the horizontal lines, even trend lines, I forgot to mention that earlier, and Fibonacci's. Right, these ones you see quite often actually. It's called a doji or a doji star. I just call it a doji. And what happens is we get a bullish candle, a bearish candle. Well, I suppose one would expect a bearish candle before this. Then you get this candle pattern here, and then this thing, it literally looks like a star. What the star indicates, and you might be saying, well, why is there no body to this candle? Why is there none of this part of the body? It's because the opening price and the closing price were identical. So it opened over here, it moved up, moved down a bit, somewhere in between, jiggled around, swam it all around, and then it ended up closing at exactly the same price as it opened. And not much movement up, not much movement down, and ending it at the same price. So you end up with a star pattern. That's a reversal pattern. So you expect the markets to move down. You see the star once again at a high probability point on the chart, and then you expect it to move back up again. All right. And very similar, I've just got some notes here. I just want to see if there are one or two. The other word for this, star, which you may come across, which is what I normally use. I don't use the word star. Different people have different ways of describing these. I call it a spinning top, which looks a bit like a spinning top, those things you used to play in the playground with kids and pull a string, and it had a little spike on the bottom, a little spike on the top, and a very narrow little bit in the middle. And that's also called a spinning top. And I just wanted to see, I think basically that's it. Oh, there's one more, which I'll try and illustrate on the charts, on the live charts with you. And that's called a one up, one down. One up, one down. That's not on these notes here. That's one of my favorite, by the way, one up, one down. And I'll try and go to the charts and show you what that looks like. So these are bearish candlestick formations. Let me just read here. A long bearish candle occurs when the prices open near the high and close lower near the low. In other words, any candle really that has very tiny wicks, as in this case, and a long body often indicates that we may have a reversal on our hands. Once again, combined with the indicators on the chart of probability. So that could be an engulfing candle, could just be by itself, but if you see a bearish candle with very small wicks, often that indicates a prolonged move down or a further move down. Dark cloud cover, this is a bearish pattern. The pattern is more significant if the second candle's body is below the center of the previous body's candle. This is similar to an engulfing pattern. If you can imagine the engulfing pattern up here. Piercing pattern, similar to the engulfing pattern as well, like that. They're all pretty similar. I suppose it's more similar to the piercing pattern. That's the bullish one. Remember, the body closes higher than the middle of the preceding bearish candle. And then when we come down to the dark cloud cover, basically what you're looking for is the same thing as the piercing pattern, but in reverse. So perhaps this is not the best of diagrams, but if you, once again, just to remind you, if you take this piercing pattern and turn it upside down, reverse the directions, that's kind of the thing that we're looking for. So in this case here, the low of this bearish candle, this current bearish candle, should ideally be below halfway of this bullish candle that precedes it. So that's that. So really what we're looking for is movement up, movement up. We're going this way now. We have a bullish candle at the top, and then we get the dark cloud cover where I'd like to see a longer body on this, really, a longer candle body. But anyway, we want to see this close with a significant, substantial body, more than halfway below, below the halfway mark of the body of the previous bullish candle. So this is the bearish engulfing pattern, identical to the bullish engulfing pattern that we saw before. This pattern is strongly bearish if it occurs after a significant uptrend. It may serve as a reversal pattern. So really, I don't think that's enough. Yes, we want a significant uptrend, but we also want this pattern here to occur at a point on the chart where we have a confluence of various indicators. Once again, horizontal lines, support and resistance, Fibonacci lines, overbought or oversold stochastic, Bollinger Bands, and all that sort of thing. So this is a reversal pattern. You can see it's called engulfing, in this case bearish, because the entire body of the bearish candle, this red one, engulfs or swallows the body of the previous bullish candle. These are very good. I like engulfing candle patterns. I like dark cloud cover, all of these, long bearish candle, they're all very good. Hanging man. This is fantastic, and you can see this on the bottom and the top of bottom of downtrends and the top of uptrends. But basically it looks like two hammers next to each other, and you can see they're, in this case, identical. They don't need to be absolutely identical. But this pattern is bearish if it occurs after a significant uptrend. If this pattern occurs after a significant downtrend, it's called a hammer. All right, same thing. After a downtrend, I would call it a spike low, as we said before earlier. And a hanging man can be identified by small candle bodies and a long wick below the bodies, which can either be blue or red. In other words, bullish or bearish. So if you see that sort of thing, just look for the patterns. It's really quite easy to identify them. We'll go back to the charts shortly and see if we can find some of these. I'm sure we will be able to find them very easily. And you'll often see that these occur when the price direction is about to change. Evening star, well, this is very similar to what we saw before over here on the bullish patterns. Over there, morning star. So we've got the morning star, which is a reversal of a bearish trend, and then the evening star, which is a reversal of a bullish trend. So the price, as you can imagine, has moved up, 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 up. We get this evening star formation, and that could signify a reversal in the trend. This is a bearish pattern signifying a potential top. The star indicates a possible reversal, and the bearish, the red candle, confirms this. So you've got a star followed by a red candle confirming that, or possibly confirming it. The star can be bullish, blue, or bearish, red. Doji star, well, we saw this on the bullish reversal patterns. This is exactly the same. Remember the star, where there's almost no body, or is in this case no body at all, of the candle, and we've got a little wick on each side. And that star formation is really good, indicates that we've got a potential change in direction on our hands. Just reading here, the doji star, this star indicates a reversal, and a doji indicates indecision. Thus, this pattern usually indicates a reversal following an indecisive period. One should wait for confirmation, like an evening star. That's here. So you can imagine that pattern, the doji star, followed by a bearish candle. So it would look very similar to this, except that we've got a star, a doji at the top, both called stars. This is a doji star, and that's an evening star. One should wait for confirmation, like an evening star, before trading a doji star. The shooting star, again, this is So whatever we see in the bullish reversal patterns, or you can apply to the bearish reversal patterns, they all look the same. They're just the other way around. And this is another example of that, the shooting star. And don't worry too much about the words. Just learn to recognize the patterns, because people have different names for these things, and it's the important point of it is not to get the names right, it's to recognize the patterns. This pattern suggests a minor reversal when it appears after a rally. So remember, it's a bearish pattern. So we're looking for the price to stall over here and then move down. The star's body must appear near the low price, and the candle should have a long upper wick. We're talking about that one there. All right. Neutral candlestick formations. The spinning top. This is a neutral pattern that occurs when the distance between the high and low and the distance between the open and the close are relatively small. So you can see that there. The high and the low very close together, these points here, and the open and the close are pretty close together. Doji, we've been over that, indicates indecision. The open and the close are the same. A double doji, even better, and you do see this quite often. When I say quite often, I mean relatively often, not every day or all day. Double doji, this candle, the two adjacent doji candles, implies that a forceful move will follow a breakout from the current indecision. Now bear in mind that from here the breakout could be up or it could be down. It doesn't mean that the direction is implied by this. It just means the market doesn't know where to go next. It doesn't know what's next on the agenda. So everyone's just waiting, all the traders, all the banks, everyone. No one can really decide whether this currency is going to go up or down. So we got a period of indecision followed by yet another period of indecision. The market could go either way. But if we use these in combination, again, with the points of high probability on the chart, where we've got a place where we would expect potentially for there to be a reversal in direction, then these can be very, very powerful and useful indeed. Mostly with trading, and I probably should have mentioned this before, mostly with trading, we're looking for the price, we're looking for reversal points. So we're looking for the price to move up, in the case of selling or going short, or changing to expecting the market to fall. We're looking for the price to move up. We're looking for some of these patterns in an area on the chart where it's probable that there could be a reversal, and then we're looking for the price to move down again. So we're mostly trading reversal areas, and these are all reversal patterns that we're looking at. These are the most important ones, and we want to trade these in conjunction with what our charts, not the price action, but the charts, the indicators on the charts and the lines that we draw on the charts, where they indicate that there's potential reversal. When you combine the two, you get a really good indicator that we're in for a reversal. Harami. These I don't really trade very much, and you don't see them all that often. I would say this is a relatively insignificant candle pattern, but anyway, it's there. It happens on occasion. This pattern indicates a decrease in momentum. It occurs when a candle with a small body falls within the area of a larger body. So it's a little bit similar to an engulfing pattern, except it's kind of the opposite. It's an unengulfing pattern. So in this case, the previous candle engulfs the current candle. If you remember with the engulfing patterns before, the current candle engulfs the previous candle. So this is kind of just swapped around. It's called a harami. And this example, a bullish blue candle with a large body is followed by a small bearish candle. And this implies a decrease in the bullish momentum on the chart. That kind of makes logical sense. Right, reversal candlestick formations further. Long-legged doji, we saw dojis with the very small wicks up and down. This is a long-legged doji, same sort of thing really. This candle often signifies a turning point. It occurs when the open and close are the same, and the range between the high and the low is large. So remember with the stars, open and close are the same, but the range between the high and the low is small. Same sort of thing, but a large. And it's also a reversal pattern. This is what I would call a spike low as well. It's a spike low combined with a doji, basically. We've got perhaps the price moving down on the charts, down, 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 down. And then we get to here, and we get the spike low with a doji. Doji really just means that the open and the close price are the same. What's important here is the spike. This is a very good one. And I'm just going to keep these both on the same chart because let's just read this first. The gravestone doji, this candle also signifies a turning point. It occurs when the open, close, and low prices are the same. So you can see there are three things that are the same there. The only thing that's different is the high price. The high is significantly higher than the open, the close, and the low. It's called a gravestone doji. Also signifies a turning point. And yeah, it's a good pattern. Now, what happens quite often, and it's probably my favorite candle pattern, and we'll see if we can find some of those, is what I call a one up, one down, which I mentioned earlier. And that's if one of these is followed by one of these. In other words, these two candles are next to each other, or vice versa. So you've got one candle that's spiking down, and the next candle is spiking up. So let's try and imagine it. There's the candle, this candle. The next one opens at this price, because that's the closed price of this candle. Opens at that price, does a spike high. Let's try and make some space. Does a spike high way up here and comes back down to roughly the same price. So you get the spike low followed by a spike high, and you get these two, something similar to these two candles next to each other. That's called what I call, don't know if anyone else calls it that, but I call it a one up, one down. Or at the top of a rising trend, you could have a one down, one up. Same thing. And those are really good indicators. Again, they don't happen all that often, but when they do, and they're in the right place on the chart itself, really good reversal patterns. Stars we've talked about already. It's a candle with a small real body. Okay, that's another word for the candle body, the real body. That occurs after a candle with a much larger real body, where the real bodies do not overlap. The wicks may overlap. Okay, so another reversal pattern, similar to what we've seen on previous patterns that we've had a look at during this session. Now, the important point is not, as I said before, not to remember the names. And there are lots more than this. I've just picked out some of the names. I've got books and books on candle patterns and reversal patterns, but these ones that I've highlighted here are the most important ones, and it doesn't really matter what you call them. I've got funny names like a one up, one down, spike high, spike low. Those are my own names for them. But what's important is you recognize what these patterns look like on the charts. Don't worry about the names. Just say, ah, yes, there's a one up, one down. There's a spike. There's a doji. There's a star. There's an engulfing pattern, and so on. I think that's it. So those are the main patterns, and what I suggest is that you can scroll through them, maybe make some drawings of them, write them down. You can pause, reverse this video and have a look and see what you think, and try and just look at your charts and recognize some of these patterns on your charts and go, oh yeah, I've seen that. I know what that is. Yes, that's an engulfing pattern, or that's a spike high and spike low, or a doji, or a spinning top, whatever. Again, don't worry about the names of these things. Just remember to recognize them on your charts. Now, what I'm going to do is I'm going to just pause this video. I'll be back in under a second. For me, I've got to open up a new window, and we'll have a look at the Euro chart and just see what we can find on the Euro hour chart that we had a look at in the last lesson. So I'll see you shortly. Right, so I'm back at the charts, and well, this is what we had a look at earlier in the previous session. What's pretty interesting is, remember I said to you in the session before that, I think it was the Sunday evening whilst the markets were closed, and then I took a trade on the 2 demo accounts, and I said I expected the euro to move up, and there was a very specific reason for that, apart from the candlestick patterns, but there were also some indicators that I was looking at, and it's moving up quite nicely. So let's just have a look at this chart. Let's just see what we can spot. The time now is about 5 minutes before the top of the hour. When I say top of the hour, I mean the change from 1 hour to the next hour. So that's where we are now. And what you can see is a doji type candle on the charts at the moment. But we've still got about 5 minutes before this hour closes. That's this current one here. You can see it's moving up and down. And we've got all the different hours going back some time. And let's just see what we... Okay, the other thing is also the time of the day. I just forgot to mention that when talking about candles. It's not only what you see on your chart, it's also the time of the day. And we get 3 main market trading sessions. I don't think I've mentioned this before. One is the Asian session, which is mainly when the Tokyo stock markets are active. You get the European session when London, primarily London Stock Exchange and the German Stock Exchange and a couple of others, the most important ones, when they're active. And then also the US session, mainly based on the New York Stock Exchange, NYSE. And depending on what time of day we're in and which market session we're in, we have to treat the markets a little bit differently. For example, in the New York session, the markets tend to move the most, followed by the European session, followed by the Asian session when things are the quietest. If you can avoid it, and it depends where you live, of course, and it doesn't mean you can't trade, but if you can, try and avoid the Asian session, because that's when it tends to move kind of sideways, like I would guess this over here that I'm highlighting. You get all these little dojis and stars, and you can see for 8 or 10 hours just about nothing happened, and one would be very wary of trading that during those markets. There's an engulfing pattern right there. You can see we've got what I call a shaven head candle. In other words, let's just try and have a look at that more closely. We've got a little bullish candle here, which is engulfed by this bearish candle, and the market carries on moving down. There's a one up, one down, but it occurred in the middle of nowhere. There's a one up, one down. That's what I was talking about earlier. But there was no other reason to take the trade apart from a potential reversal happening at the bottom of a very small downtrend, so not much room in it. One up, one down, and that could have indicated a bullish reversal, but there was nothing else to back that up. There's a spike low. This is a good example. Actually, 3 candles in a row that would indicate. I'm just showing you how easy. You don't even need to know what they're called. Get rid of that. 3 candles in a row which indicate a reversal. There's the bearish candle, that one there. You can see it's got a very small lower wick, lower tail, as some people call it. high, quite a high upper tail or top wick. So it's kind of like a reverse hammer. So it's an upside down hammer. That's a reversal pattern in itself, followed by a bullish engulfing candle. That's another reversal pattern. In other words, so we've got a downward trend, quite a good one. Another little tip I'll give you, just whilst I'm looking at this particular area in the chart, if you've got more than 7 bearish candles in a row, or more than 7 bullish candles in a row, between 7 and 10 or 11, the market's often due to change direction. Just a little tip thrown in there. But anyway, back to these. So we've got a little upside down hammer, a reversal pattern, also with a little spike. Then we've got an engulfing pattern. Then we've got a spike low. You can see almost a doji, a very small body, a long-legged doji you might call it, as we looked at in the notes, with a quite long wicks and a tiny little body, but also it's also a spike low, followed by a proper long-legged doji, this one here, that you can see, where we've got no body. The opening and the closing price were exactly the same, and we've got quite long candles, followed by another bullish engulfing candle, and we see the price moved up. So that's a classic. That's actually a four candle reversal pattern. You don't see that too often, but once we got to there, after that one, this long-legged doji, after a bullish engulfing, spike high, reverse hammer, engulfing spike low, followed by this long-legged doji, another reversal, 4 reversals in a row, and we can see the price moved up. Good opportunity for trading. It also so happened that it was at an area on the chart where one would be looking for a reversal, apart from the price action that we were talking about. Here's another one. We've got another reverse hammer. You might even just want to call that a spike high with a very small body, but it's a good strong reversal pattern, followed by something similar to a doji, but it's also in its own way a little engulfing pattern. So you can see the body of this white bullish candle, slightly bullish, engulfs the body of the preceding bearish candle. That's a good reversal pattern, and you can see the price moved up. So these are the sorts of things we're looking for. I'm guessing this was another Asian session. You can see it's sometimes tricky. It's not always like that, but sometimes tricky to trade. There's a bullish engulfing pattern, very classic. There's the previous bearish candle. I like engulfing patterns a lot, along with one up, one downs. Those are my 2 favorite, I think, and spikes. So there's the bullish engulfing pattern, engulfs the previous bearish candle, and we got a lovely strong move up thereafter. And it would be good to take profit at about 50 or so pips on that trade. We're going to talk about pips as time goes on. There's another Asian session. You can see you get a lot of indecision during the Asian market. The reason is there's not a lot of volume. The majority of people in the world, the Americans and the Europeans and the British, they're all in bed or doing other things, watching TV, having a barbecue, and so on. So we've got a long move down here. Here's a classic example. This is a bearish pattern. We looked at bullish ones earlier. We've got 2 stars in a row, straight after a bullish candle, shaven head. In other words, there's no wick on the top of this white candle. Often that indicates that we've run out of gas and that we might change direction, followed by 2 stars. Remember I said you don't see this very often, but when you do, it's often a good sign. And that was followed by a lovely move down, a really good one, probably 100 or more pips. So that's a beautiful bearish reversal. And you'll begin to spot these as time goes on. Here, remember we talked about the bullish reversal pattern of a bullish candle closing above halfway up the preceding bearish candle there. Okay, there's the bearish candle, there's the bullish candle. It's closed more than halfway above the bearish candle, and that's also a sign of reversal. It took a little time to get going, but eventually it moved up. Then we get a bearish reversal pattern, actually. We get two spinning tops or doji type patterns in a row, and then a move down. So yeah, you know, we could look through these all day long. I think again there's another Asian session. When you get a big bullish candle like this, sometimes it's problematic because it's moved up too much to get into the market with a decent risk reward ratio. Because if we bought the market at the close of this candle, in other words, we went long on the euro against the dollar, we'd have to have our stop loss below this previous low over here, which would be quite a long way away, probably 40 something, 45 pips, something like that. And that would be too much risk to take, unless you went with a very small lot size. As it turns out, it eventually did move sideways for a long time, up a little bit and then down. There's another bearish engulfing candle. Look at that, it's a beauty. All right, so that's really what you're going to be looking for. We'll go through those notes. Here's another Asian session, followed by a couple of reversal candles in a row, and then the market took off and went up over there into the Asian session. And if you are interested in trading day charts, you can look at exactly the same. If you haven't got the time or the inclination to day trade on shorter term charts, you can do it on day charts, exactly the same thing. Just looking at this in very brief, there's a slight move up, there's a one up, one down over here, or one down, one up. That's a classic combination. We want to see it taking place against a Bollinger Band, resistance line, a Fibonacci line. We want to see an overbought or oversold stochastic, in this case overbought, and perhaps a moving average or something like that. And you can see we had a fantastic move down for more than a week. So that's what I refer to when I say those two candles. Remember I said you can put those two candles together and you get a one up, one down. There's a classic example of that. So what I want you to do is to just go through your charts. You can look at day charts, hour charts, any type of chart you want. Doesn't as you go down towards half an hour, 30-minute charts, 10-minute, 5-minute charts, and so on, as you go down to smaller time frames, these become less reliable. And I would stick with the minimum time period of an hour. Right, well, I hope that's been helpful. That was candlesticks, and we'll obviously refer to these as time goes on a little bit more when we're talking about all the other stuff. But that's the broad outline of what candles are about. And as I said, make notes, reverse, rewind, pause the video, have a look at those, look at your trading charts that you should have got onto your computer by now, or you will do soon, and see if you can spot some of these patterns. And I'll see you in the next video. Take care.